The Great Recession by the Numbers, and tracking one of the oddest years in the history of America's economy. A year ago this weekend, the Dow Jones Industrial Average had just finished a slow-motion crash. Over 8 days it fell 2,400 points, or 22%, and stood at 8,451. A year later, the Dow is at 9,865. It's up 51% from a 12-year low of 6,547 on March 9th, when some investors feared the financial world was coming to an end. But the complete story of the Dow's journey since the economy soured goes back a little further. 2 years ago this week, on October 7th, 2007, the Dow set its record high of 14,164. What followed was a 3-act play. For 5 months, from October 2007 through the collapse of investment bank Bear Stearns in mid-March 2008, the Dow fell 2,000 points in an orderly fashion, as investors anticipated a garden-variety recession. But these are times like never seen before. From mid-March until Labor Day in early September, the Dow rose and fell, but was little changed. But right after Labor Day, Fannie Mae, Freddie Mac, Lehman Brothers, and AIG failed over 10 days. The credit markets froze, and investors panicked, fearing another Great Depression. There were rallies amid the downward spiral that ensued, but over 6 months until the low on March 9th, the Dow fell 5,000 points. So, where do we stand today? The 7th-month rally since March has yet to wipe away all the losses, but few expected that the Dow would be edging back to 10,000 so soon. Unemployment is close to 10% and still rising, but other parts of the economy are theoretically stabilizing. They call it a jobless recovery, but it's not really recovering to where it used to be, is it? Consumers are still hunkered down, but retail sales showed a slight gain in September. The panic of last fall has been replaced by the resignation that the worst is over, but it could be years before the economy theoretically booms again. There are fundamental problems with the world's financial systems. Here's a by-the-numbers look at the stock market and the economy since the 8-day crash approximately 1 year ago. $11.2 trillion. Total losses in the stock market from the Dow's peak in October 2007 to the March 2009 bottom. $4.6 trillion. Total gains in the stock market since March 9th. 6. The number of the 10 worst point drops in the 113-year history of the Dow that occurred in 2008. The 777-point drop on September 29th, 2008, ranks number 1. 3. The number of the 10 worst percentage drops that occurred in 2008. The September 29th decline of 9% is the third biggest behind 22.6% on October 19th, 1987, and 10% on April 14th, 2000. 92% decrease in Citigroup Incorporated share price from October 10th, 2008, $13.90 to March 9th, $1.05. 341% increase in Citigroup's share price from March 9th to last Friday's close of $4.63. 18 to 20. The historical average for the Volatility Index of the Chicago Board Options Exchange, also known as the VIX, or Fear Index. 89, where the VIX peaked last October. 23, where the VIX was on Friday. 16%, the amount by which the Dow's closing level on Friday was higher than its average close the previous 200 days. Earlier this month, the number hit 20%, the highest since the early 1980s. $6.5 trillion. Value of assets in stock mutual funds at the end of 2007. $3.7 trillion. Value at the end of 2008. $4.5 trillion. Value at the end of August. Minus $72 billion. Net cash flow. Money put in minus money taken out for stock mutual funds in October 2008. Minus $25 billion. Net cash flow in March. $4 billion. Net cash flow in August. 9. The amount out of every $10 investors put into mutual funds in August that went into bond funds. $855.40. The price of an ounce of gold on October 10, 2008. $1,048.60. The price of an ounce of gold on Friday. 6.2% unemployment rate a year ago. 9.8% unemployment rate today, and still rising. 95.2 consumer confidence 2 years ago. Reading above 90 means the economy is on solid footing. Above 100 signals strong growth. 25.3 consumer confidence in February, a record low. 53.1 consumer confidence today, still low. 2.8% decline in retail sales in October and December 2008. 2.7% increase in retail sales in August. 4.75% federal funds rate 2 years ago. 1% federal funds rate last October. 0 to 0.25% Fed funds rate today. 4.81% London Interbank Offered Rate, LIBOR, the amount banks charge each other to borrow money for 3 months. At its peak on October 10, 2008. 0.28%, the 3-month LIBOR rate Friday. Minus 0.5% personal savings rate in 2005 as home prices were soaring. 6.9% personal savings rate in May. $975 billion credit card debt held by Americans last September. $899 billion credit card debt held at the end of August, down 8%. 7 million home resales in 2005, a record year. 4.5 million home sales in January at annual rate. 5.1 million home resales in August at annual rate. $245,000 median price of homes sold in 2006, a record high. $213,000 median price of homes sold last October, and $195,000 the median price of homes sold in August. The price of homes are still falling. So, a jobless recovery. What does that mean? It's not really a recovery, is it? Again, no jobs creation, no real economic recovery. It's more of an illusion, because it's not recovered. The economy is not recovered to where it used to be. Not even close. Well, sorta or kinda, but it's got a long ways to go. So, no jobs, no real economic recovery. And there's something much bigger going on here. Everything is connected. These are more signs of the end times transition days, as the transition is ongoing day by day all around the world.